Hello, finance students. We are on ICA 4.4. We're going to be looking at three more financial ratios. More specifically, we're going to be looking at profitability ratios. These ratios answer the questions: has the firm earned adequate returns on the things in which it has invested? Or looking at the investment in assets, investment in sales, and investment in equity. So we're going to start with this first one. We're going to look at return on assets. And the return on assets basically measures the return on invested capital in both short-term and long-term assets, in both current and fixed assets that we've looked at already on the balance sheet. Now notice, return on assets takes into account two things. It takes into account management's success in controlling expenses, which we will look at more specifically here in the profit margin ratio, but it also takes into account management's efficient use of assets to generate sales, which is our total asset turnover ratio. So we notice that our return on assets is really a combination of two ratios: profit margin and total asset turnover. So to calculate this, we are going to look at net income versus total assets. Now, your book may look at operating income, which is earnings before income and taxes. But for our class, I want us just to look at straight return on assets, return on sales, and return on equity, comparing net income to those three different items. So for return on assets, we are going to look at our net income divided by our total assets. So to find net income, we know that's on our income statement. So we type equals. We find our net income down here at $45,687. We hit our divided by key, which is our forward slash, and we look for our total assets, which we know is on our balance sheet at $321,686. Once we have our formula set, we can hit the enter key, and that gives us a return on assets of about 14.2%. Notice this is a little bit higher than the industry average, which is not too bad. The industry is at about 10%, so they're actually getting a return of about 14% on the asset in which they have invested. Our second ratio is profit margin. Profit margin essentially tells us how much profit has been generated per dollar after all costs have been taken into account. Again, we are going to look at net income or earnings of an organization rather than their operating income or their earnings before interest and taxes. This really shows control of expenses by management. As this ratio continues to go higher, it's showing that costs are being reduced or controlled much better that we see. So we are looking at costs such as cost of goods sold, the operating expenses. We're looking at internal costs versus external costs, looking at interest that needs to be paid, taxes that need to be paid, those kind of things. So to calculate our profit margin, we need net income, and we're going to compare it to sales. So we type our equal key. We know net income is on our income statement. So we have our $45,687. We hit divided by, and we find our sales, which is also known as revenue, at $215,639. We hit our equal key, and that gives us a profit margin of about 21%, which again is pretty good that we see. Lastly, our return on equity is a look at the return that stockholders have. Stockholders, obviously, when you buy part of a company, when you're an owner of a company, you expect a return on the money that you lend to the organization to be used for operations. So this ratio, return on equity, tells how well those stockholders or those corporate investors are doing. And what we're looking at is we're comparing our net income to how much common equity is outstanding. Our net income is basically the earnings that are left after everything has been paid, and we're just comparing it to the amount of dollars that have been invested. So net income per dollars. Obviously for this one, again, investors like this to be as high as possible. So to find that, we're going to find our net income. We're going to type our equal key. We know our income is on our income statement, $45,687, divided by our forward slash. We find our equity right here on the balance sheet, total shareholders' equity of $128,249. We hit enter, and that shows us that in that year, Apple investors, shareholders, were earning about a 35.5% return, which is very, very good, especially compared to the industry average of about 19.3% that we see.